Welcome, everybody, once again to Fixated on Real Estate's Experts Live. I am your host, Tarl Yarber. This week's show, we have an awesome panel for you, just like every week. This week, we're talking about how to raise money and raise the capital that you need for pretty much any deal that you do in real estate, whether it's single family investing, multifamily, commercial, doesn't matter the dollar value. We're going to get into this particular panel today. I'm very excited to have these panelists. We have Anna Kelley, that you guys are going to love. We're going to learn more about her. Ashley Wilson, one of my favorite people. And of course, one of my best friends in the world, our perpetual guest, Mr. Jay Scott, is going to go into explicit detail on many things about raising capital. We get into the different funds that you can use, the different syndications that there are out there, what the different vehicles are for raising capital to begin with, whether it's private notes or syndication or funds, or even just leveraging with seller financing and so forth, whether or not you go to a traditional bank. We're going to go over also what's changed this year versus last year, because as you guys know, in 2020, the entire investor market has shifted just a little bit. And is investor confidence still strong when it comes to real estate? And how easy is it to actually still raise money today versus yesterday? And what will it look like in the future? So stay tuned and let's get into it. What's up, everybody? I'm Tarl Yarber with Fixated on Real Estate. And once again, welcome to Fixated on Real Estate Experts Live with my good buddy and perpetual guest who contractually obligated cannot be the actual co-host of this event, Mr. Jay Scott. Welcome, Mr. Jay.
Thank you. I am thrilled to be back for the 828th week in a row.
That's right. One day you might be a co-host, but I don't know if that's ever going to happen. So check out the Bigger Pockets Business Podcast because that's why he's not the host of this. That said, we are excited today to invite two lovely ladies to our Fixated on Real Estate Experts Live. Today, we're going to be going over raising capital for pretty much any deal. Everybody on this panel has definitely raised capital. We all have different experience levels with it, and we're here to answer your guys' questions, but also dig into the nuts and bolts of the different types of raising capital, how to actually do it, when you should do it, and when you should just go to a traditional lender, or when you should do both, or even joint venture, or syndicate, or raise funds, or any of that great stuff that we all want to do and get lots of money for free, right? Let's first introduce the lovely panelists. I'm going to start with Miss Ashley Wilson. How you doing, Ashley?
Great. How are you doing?
Super duper. I saw Bradley Cooper in the background a second ago walking by. That's your husband, right? Or is that Kyle? I can't remember.
Well, let's not tell Kyle, but Bradley's over right now.
That's right. Love it. So guys, check it out. Kyle does look like Bradley Cooper. So Ashley Wilson is the co-founder of Bar Down Investments and LLC. She's also CEO and founder of How's It Look? I can't say it, LLC. She has over 10 years of real estate experience, has been involved over 40 million in transactions within both single family and multifamily. Ashley is co-founder of Bar Down Investments LLC with her husband, Kyle, aka Bradley. Ashley leads asset and construction management on her multifamily investments and has provided operational consulting for several large multifamily owners throughout the country. Additionally, Ashley and her father, Tom, also have a very successful high-end flipping business in Pennsylvania, How's It Look LLC, which handles several millions in transactions annually. You know a thing or two. We're excited to have you, Ashley. Thank you for being here. And
thank you.
We also have Miss Anna Kelley. Anna is the founding partner of REI Mom LLC and Greater Purpose Capital Group LLC, a real estate company dedicated to creating a meaningful impact in the communities in which they invest. Anna is former top-ranked financial relationships manager for a private bank and has invested in real estate for over 20 years. She has purchased, renovated, and rented millions of dollars in real estate across numerous asset classes. Anna has active ownership and asset manages a multifamily rental portfolio we're valued over 80 million and has invested over 2,000 doors. She's also a 3 times Amazon #1 bestselling author. Anna, this is the first time we've met. Thank you for coming out. Welcome.
Thanks so much for having me. I'm excited to be here with y'all.
All right. We're looking forward to having both of you too. And of course, my good friend, Mr. Jay Scott. He is the CEO and author of every single book Bigger Pockets has ever written whatsoever. And I think he's got like 8 of them, at least, something like that. Maybe another one coming. He is an entrepreneur, technologist, investor, and advisor, host of the Bigger Pockets Business Podcast, author of 4 Bigger Pockets books. It's 4, I guess. Including the book on flipping houses, the book on the estimated rental cost, the book on negotiating real estate, and recession-proof investing. Real estate investor that's completed over 400 plus deals, plus including flipping, buying and holding multifamily notes, just did a syndication with Ashley Wilson. And you guys bought a property.
And Anna Kelley.
Oh, and Anna. Oh, my God. I didn't know that. Fantastic.
Trifecta.
How much was that property that you guys bought?
Just over 20 with everything.
$20.
All in. 20 million.
Oh, 20 million. All right.
20 million.
20 million. Had to raise capital for that, I take it. So this is going to be a good time to talk about that as well.
We did.
Awesome. So happy to have all of you here. Today's topic is raising capital. Let's start off really quick, Jay. For everybody that's watching this right now, can you just give us a quick synopsis on what are the different types of vehicles for raising capital? Why would somebody do this? When it comes to real estate investing, whether it's single family, multifamily, it doesn't really matter. What is this all about? What is these terms? What is a vehicle? What is this stuff? Why should we raise capital? What are these things called? Can you help us out?
Yeah, so we use the term raising capital to mean a whole bunch of different things, and I could talk for the next 3 hours just defining what it means. I'll try not to do that. But basically, raising capital is everything from first. When we talk about raising capital, we could be talking about debt or equity. Debt means you're borrowing money. So basically, somebody's giving you money, you're paying them interest on it, and if for some reason you lose all their money, you're still required to pay them back. They're basically a lender. Think of it as a bank. That's one way of raising money. The other is equity, and that's where somebody is basically giving you money to be a partner in a deal. Now, they may be an active partner where they actually participate in the deal. They may be a passive partner where they give you money and you do all the work. But basically, they're then sharing in the risk. So they're giving you money to do a deal. If you lose money, they lose money also. So there's the debt and the equity side. Then there's there are little deals. Maybe you're going to borrow $20,000 from somebody, you're doing your renovation and you need to replace the roof and you don't have money to replace the roof. So you borrow $20,000 from somebody to replace the roof. On the other side, maybe you're doing a multifamily apartment complex that you're what's called syndicating, where you're bringing in a lot of investors and you might have to raise 10 or 20 or $50 million. So basically raising money kind of encompasses a whole lot of things. It even encompasses some creative stuff like sometimes you get the seller of the property to put in some of the money for the sale. So let's say seller has a property, you're buying that property for $100,000. Maybe you're going to give them $10,000 now, and you're going to give them $90,000 in 6 months when you're done flipping it. In a way, that seller has contributed money to the property. They've taken some of the equity they've had in the property, and they're not forcing you to pay for it right now. You can pay for it in 6 or 12 months. So in a way, that seller financing is a way of raising money. So when we're talking about raising money, it's basically anytime you have somebody from the outside helping you pay for stuff that you need to do a deal.
But what about this whole thing about no money down, buy houses with no money at all, that kind of thing, or properties? Is that kind of the same thing you're talking about here?
It is, and it is possible to do no money down deals. I think too often we assume that everybody's out there doing no money deals, and all the good real estate investors have done 1,000 deals and have never paid a penny. In reality, that's not the case. Typically, you need money. Even if you don't need money to buy the property, oftentimes you need money to do the marketing to find the property, or you need money to do the rehab, or you need money for the closing costs. There are lots of ways to get money. And if you're really good and when you get more experienced, there are ways to get pretty close to needing absolutely no money for a deal. And if you're really, really good, maybe you don't need a single penny. I've done deals where I haven't needed a single penny. But for most of us, that's not common. So don't go into this business thinking I don't have a single penny to my name, and the only way I can do it is if I can do literally no money down deals. Because if that's the situation and you're probably going to be disappointed.
Fair enough. I like it. So, but that said, now we all got started in this business in different capacities, different ways, how we all got introduced. And I found that over the years, as people get started in real estate, their ability to raise capital changes, how they structure deals, how they get their financing, the costs associated with it, the size of the deals, all changes and escalates over time or retracts depending on their type of business. So Ashley, when you guys got started flipping houses, I believe, is that correct? How did you guys fund your deals when you first got started doing single family homes many, many years ago?
So when we first got started, we actually didn't have access to a bank lender, and we weren't really wanting to go the route of hard money lending. So we actually purchased the houses in cash and did the renovation in cash. I know that a lot of people don't have maybe that opportunity that we had to do it in that manner. But ultimately what that did is it kicked the can down the road for us to have a a point in which we need to figure out alternative ways in which to source capital. At the end of the day, you're going to run out of your own capital at some point. And what the goal of any investment, whether it's real estate related or anything else, is to decrease the cost of that capital. So if you're going by routes of a hard money lender, that's probably the more expensive route to take on a single family. Even syndication might even be a more expensive cost of capital. We were fortunate enough to find a lender, a bank that lent us the majority of the money, 80% on the purchase and 100% on the construction. So now today we only put the down payment, the deposit of about 20%, depending on the property.
I like what you said there, because there's a number of people that say every day is like, why would I've actually had many people talk to me about this. If they have the capital, why would I pay a lender 8%, 10%, 12% points, all that kind of stuff? It's cheaper if I just pay cash for the deal, right? So, and you mentioned what that does, eventually you run out of capital, right?
Correct.
And almost every investor I know that runs a business, right? Capital is one of the most important things. And if you don't have any working capital, you can't run your business. And you can only buy so many deals if you're always paying for everything yourself, right? So
yeah. And I think if people start off with finding alternative measures, then really their bandwidth comes into challenge with number of deals and maybe team and resources as opposed to capital, because there's three components to every deal. It's the deal, the capital, and your team. And if you could find a solution to the capital up front and then just focus on deal sourcing and building out your team, so you have an A squad, a B squad, a C squad, you can scale very quickly. Our scaling was stifled because we ultimately did not focus on capital first. We had capital that we could invest, and we realized that, we were finding the deals and we had the team because of experience with my father and him being a general contractor his whole life. So he had connections that we could really leverage. But ultimately, capital became our biggest problem. And it became the problem a couple of years down the road when all of our competition had already figured it out.
Love it. And that's absolutely true. So Anna, how did you get started? Did you get started in single family, or did you do some sort of other investment process?
Yeah. In terms of properties, I had a small rental property, and then I decided I wanted to be a stay-home mom when I had my first baby. So that was in 2003 when all the Flip This House shows just started to come out. And we decided to flip houses. We thought that was going to be the way to financial freedom. Did it, didn't love it. My husband said, we're not doing that again. And so we relocated from Texas to PA, and I basically started buying rental properties. So we bought a property for my husband to practice in that had some tenants. We inherited those tenants and realized this is pretty nice to have, part of our expenses covered. And then we house hacked a 4 unit. So we started rental property, because we wanted to be smart with our money. And then we basically slowly kept buying small multifamily properties. So other than the first, big flip, we've done some flips here and there. We do vacation rentals, but really we got started on buying a whole bunch of small multifamily properties to try to create that financial freedom through the cash flow so that I could retire from my corporate career. And then we just scaled up to larger apartments from that point.
And how did you finance those early on in your business?
So in the beginning, we used credit cards. Our first property that we bought, it was in 2007 when bank lending was pretty easy if you had good credit. So I had a 90% first, and they let me open a 10% business credit card. I got in 100% financed. The days of those kind of financing is over. So it worked on the first one. The second one we house hacked, and I did an FHA loan, and I pulled some savings and, put 3% down. But from that point on, we really had to find how are we going to make money with no money? Kind of the same thing Jay said. And it was a lot harder when you didn't have a network. We didn't have other people to bring us money. We grew very, very slowly because we'd save up the cash flow from one investment and we couldn't buy the next one until we figured out how to come up with more capital. So that's what led me to start being creative and looking at things like seller financing, partnering with people on a deal, bringing in an equity partner for the down payment, and splitting that cash flow until we started growing and eventually started joint venturing and syndicating.
That's a good point. I like also what you're also talking about is that scalability of the business. You got to a point where like, oh man, we got to save more money or else we can't buy more deals. And I've seen over the years talking to other investors when they're starting out, or when they've been in it for years, they're stuck. And one of the things that keeps some investors stuck is the ability to buy more deals, like the financing portion of it, the funds, and all that great stuff. So it's interesting when you talk to like groups like this now, like where we are, all four of us and other people, is we feel, at least for me, the money's the easy part now, right? And I remember when I was newer, when I'd hear, oh, the money's the easy part, I'd be like, you're lying to me. Like, that's not true at all. And so the money's the hardest part. But now that we are, I'm like, oh yeah, money is the easiest part. You just, there's plenty of people that want to give it to you if you got a deal. So let's talk about that a bit, right? As far as, crossing that bridge over from people that, are starting out in the business, they're mid-level, maybe they're highly advanced. Because for those of you guys watching right now, we're going to get into some of the bigger stuff. Like these guys just syndicated a $20 million deal, the three of them, right? That's a big deal to syndicate. So what is that? What is syndication? So we'll get into that too. And what that's like to raise capital for that much, why not just go to a lender for that, right? I went to a seminar one day that said you could just go to a lender to get that much money, but apparently not. So we're going to dig into all that. So Jay, talking to Mr. Jay Scott, when it comes to crossing over to that bridge from, okay, I'm saving my own money, I'm going to go invest, right, into these deals, I've run out of capital, right? What are some of like the major pitfalls? What are some of the challenges that you think that most investors kind of face for themselves to start actually asking other people for money? And what are the different ways they can get money from other people to be able to help pay for their deals? Specifically, we'll just keep it to single family for right now to keep it easy, and we'll switch over to multi here in a little bit.
Yeah. So one, I'm going to start with it's not easy, but it's simple. It's one of those things. It's simple, but it's not easy. So simple in the sense that there are lots of people out there with money. You come in contact hundreds of times a day with people who likely have money that if you could do a good job of convincing them, they would be willing and able to lend you or partner with you. Friends, family, coworkers, colleagues, coworkers and colleagues, same thing. Professionals, you go to your doctor, you go to your dentist, you go to your attorney, you go to a random dinner party and you meet people. So keep in mind, everywhere you go, there are people that have money that have the opportunity to give you money. So you need to just get in the habit of treating people like they are possibly money lenders or partners, people that can invest money in you. And so the first thing is that mindset shift of there are only a couple people out there. I need to find them and I need to convince them. The mindset shift is no, everybody, or not everybody, but a lot of people are potential partners or money lenders. So that's number one. Number two, I think the biggest impediment to getting private money for a lot of people is this mindset that the other person, the person that's giving me money, is doing me a favor. In reality, for most of the people that lend me money, they feel like I'm doing them a bigger favor than they're doing me. Basically, I'm giving them 8 or 9 or 10 or 11% interest on their money. Whereas if they didn't have me, what would they be doing with that money? It might be sitting in a savings account at 0.5%. Maybe it's in the stock market earning 6, 7, 8%, but highly volatile. Maybe they're doing their own real estate deals, but they have to put in a lot of time and effort to do it. So they probably don't have another passive vehicle that they could be making the same returns that I'm offering them. And so if I can convince them that I'm going to be a good steward of their money, if I'm going to be somebody who takes care of their money and I invest wisely and I'm going to treat their money and I'm going to treat their money well and their investment is safe, then from their perspective, they're getting a much better deal than I am. I'm getting this money, but they're getting a return. I can get money from anywhere, but they're not going to be able to get a return like that from too many places. So the key is one, mindset shift that you're doing them a favor as much as they're doing you a favor, because it's much easier to go into a situation where you're asking for something when you feel like you're giving equal value, as opposed to you're just begging. And then number two, treat everybody you meet as a potential partner or potential lender. Have the conversation. Say, hey, this is what I do. And if all you say is I'm a real estate investor and I do a bunch of deals, the conversation's naturally going to flow from that. How many deals do you do? Oh, really? How are you doing that many deals? Where's the money coming from? You're naturally going to be able to fit into the conversation. I work with partners, I work with lenders, just people just like you, actually, who give me money in return for a good return. Oh, really? What's a good return? Sometimes we pay 8, 9, 10, 11, 12%. Deal is secured by real estate. Oh, that's interesting. And now in the back of their mind, they're thinking, how do I get in on this? As opposed to you saying, hey, I need your money. And so just treat every conversation that way. And over time, it takes time. Just like anything else, it takes work, it takes time. But over time, what you'll find is that you start building these relationships and you'll have people coming to you saying, hey, we met at the party last week and I got your name from the host of the party. And I remember you saying that you sometimes like take money from people and you give them a good return. Can we talk about that? And you'd be surprised.
Eventually have people just reach out to you, and it's crazy.
I've had more people that I don't know reach out to me just because they hear this is what I do. Because I've talked to enough people about it that I have more money than I have deals.
I think that's a great point on a lot of levels. And this is it doesn't matter. So anybody watching or listening to us right now, if you're looking for a single family home that you just need $50K on, right, or less, or you have a $20 million syndication, it's this, in my opinion, it's the same process, right? And it's just one, you might need more people, right, than the other. But it's the same conversation. It's the same situation. It's just, you might be showing certain data, you might be showing certain aspects, but you're still playing that same game of reputation and relationship and asking, right? So if you don't ask, the answer is always no, right? And so I love that you said that, but I think it's completely what you said, Jay. It's a mental shift for most of us newer investors that are out there to sit there and realize, wait, other people want to give me money because they don't know where to put it, right? And maybe there's an education gap of knowing how to accept that money from other people. Traditionally, you don't just accept a cashier's check from somebody. Typically, there's a legal component to that of how you're supposed to do that to protect everybody, which we'll get into slightly a little bit later. But Ashley, talking to you, for you guys, when it comes to giving some key advice to people when they want to start accepting money from other people, where do they start as far as what do you think is the number one thing to portray to other investors, private lenders, private people that you believe is important to portray to others or build up in yourself in some way to be able to get people to trust you, to be able to actually give you money on houses?
I think at the end of the day, what you're trying to identify is what problem you're solving for them. So ultimately, a wise man by the name of Dave Van Horn once told me that there are two types of people. There are wealth building mindset people, and there are capital preservation type people. So those two types of investors are going to be looking for two different investment opportunities. Someone who has a more wealth building mindset is going to be looking for higher returns, riskier type of investments, whereas someone who's in a capital preservation mindset, they're looking for more stabilized performing assets, and they're probably looking for smaller returns, but more stable returns. Ultimately, what you want to be able to understand and provide to them is a solution to whatever challenge they're facing. Are they facing a situation with major tax burdens? Investing in real estate is one of the greatest vehicles in which you can delay your tax burden, your tax hit. That's one of the best advantages in investing in multifamily, for example, because of cost segregation and bonus depreciation. So if you can really understand and have these engaging conversations with investors and then be able to offer an opportunity, to Jay's point, it's really that mind shift. And it even goes all the way down to the language in which you speak and which words you use to talk about the investment. Is it an opportunity or an offering? That's one thing I had to get my mind around when I first started talking to investors is this is an opportunity for you to invest. This isn't offered to just any investor or any person. So really understanding the person's individual goals for investing, where they are in their continuum of life and investment strategies, that's helpful too. But those are the conversations you want to have, and then you want to continue to have, and then you want to highlight what value you provide in that particular investment. So the most important thing that any investor should look at is the person in which they're investing. oftentimes it's the deal and the returns, but that's a mistake. There's three components that you're looking at in a deal. You're looking at the deal, you're looking at the market, and you're looking at the team. And oftentimes investors look in that order, but it should be the reverse. And you should provide that education and, provide guidance to say why that's important to invest in the person and the team first, the deal and the market second. And if you provide value, you provide education, I think that comes back at you tenfold.
Love it. So Anna, what comes first? Like what should we focus on first? Should I focus on getting the deal first, or should I focus on getting the money first?
So I think, getting really good at real estate, and as you progress as an investor, really the key is seeing what kind of opportunities are out there. So what kind of deals are out there, but then getting really good at becoming the deal maker. So I look at deals and I say, where are there opportunities today in the niches that I'm comfortable with and I have experience that marry my time, my skills, my money, and my financial goals? And if they're big deals that I can help utilize other people's time, money, and skills to meet their financial goals. And so really, I'm out there looking at deals to say, where is their opportunity? And how can I creatively put together a deal with the right team of people, the right team of investors, where that deal is helping them, to Jay and Ashley's point, to meet their financial goals. And I can be the person to help put it together to benefit my own personal financial goals and theirs as well. So I'm always looking for deals, and I'm always looking for investors and looking at what are my investors looking for. And all of us have kind of a different network of people and a different type of investor. And to Ashley's point as well, when I did private banking, we had the top wealth of our bank coming to us for financial advice. And we would say, okay, are you in an income phase where you're trying to create a whole bunch of passive income or active income? Or are you in this growth phase where you're going to take a little risk, but you want some big upside on the back end? Or have you already developed your wealth and now you're in capital preservation mode? And so as I'm meeting people and I talk to them about what I do and the fact that I did create financial freedom and I'm retired, at age 44, people want to know, how did you do that? And so I tell them I did it through real estate, and there's opportunities to help you meet your financial goals in different types of real estate. And then I just have a conversation with them. What are your financial goals? Do you want to create financial freedom, or do you love what you do and you want some growth on the back end? Or are you in preservation mode? And then I talk to them a little bit about the types of deals that we do that would help them to move the needle toward their goals if they're ever interested in investing actively or passively. So I look for deals and investors at the same time all the time. And then I try to marry them together.
Both.
Did you hear this comment? Did everybody pick up on the common thread of having conversations? Just have conversations. I think all three of us have now said it. It's just about having conversations.
Yeah,
totally. And I just want to add one thing though. Your reputation is a big deal in all of this. And so it's not just the conversations, but it's if you're just starting out, typically on these, we don't talk to the brand new person too much on my shows here. We try to talk to the middle level investors so that we can help raise them up. And if you're if you're brand freaking new, then you need to up your game, right? But if you're brand new, sometimes you need to do a couple of deals before you can start raising any private money. And I think one of the challenges some of us have is that we want to make all our money on the first deal, and sometimes we can't do that. Sometimes we need to give more equity to other people, pay higher costs through hard money lenders, do all this kind of stuff to get that credibility to get cheaper capital later. And that's totally what I did. I mean, I remember one time when I really got going in 2012, I was giving 80% away of the equity on single family homes because money was hard for me back then. And I was doing all the 100% of the work, right? But that came from joint ventures with people. But eventually I did tons of deals and a bunch of other stuff. And then all of a sudden became 30%, then 50%, then 60%. Now I don't pay anybody 80%. So, but it came with credibility and time to build it up. And I just wanted to do the deals and get to work. And then you build your reputation, you build your processes and all that kind of stuff, and you get cheaper and cheaper money all the time. So, but it starts with that first one, right? And you have to build your little portfolio, your reputation, your credibility to have these conversations and just get started. So that said, let's switch over to some of the bigger talks. Like, let's talk about funds and syndications and private notes and lenders and when you need to do all this stuff and what are they? And so let's start first with did we already ask this question? What is a syndication? I hear this word everywhere. What is a syndication? Did I ask that yet? No, I didn't ask that yet. All right. Who wants to go? Ready? Dead air. Ashley, go.
A syndication is a way in which you can raise for an investment. It doesn't necessarily have to be a multifamily. It could be a self-storage. It could be a mobile home park. It's just a way single family even, correct. It's a way in which you can pool together funds, and you typically, in a stereotypical model, there are two groupings. One is called the general partnership, and they are actively managing the deal, inclusive of finding the deal, finding the debt, sourcing the equity, operating the property, doing a refinance if necessary, or some other capital transaction like disposition, and also keeping the other group, the passive investors, otherwise known as limited partners, involved in the deal in a passive manner. So they are doing distributions to the passive members. They are informing the passive members on the financials and the operational conduct of the property. So there are different ways in which a syndication can be structured, and it's deal by deal dependent. It's also operator dependent. Everyone kind of has their own niche that they like to pursue when it comes to syndication. But it's a very good way in which you can leverage resources. And the name of the game for investing is always the ability to leverage.
So it's pooling everybody's money together for a single deal for the most part. And you can't just like give out 18 deeds of trust and notes on a deal. So you're basically putting one together, right? But
you're coming together on the entity that's purchasing the property. That's how it works. And then that entity owns the property.
Got it. So it's people are investing into the entity.
Correct.
You said limited partner, which would be the investors, right? And that's one of the terminologies that I was confused with a long time. Like, I'm an investor, but that's not what we're talking about. We're talking about like people that investing money only. And then you have the operators or the general partners or whatever that's a different term. So I had to learn that a couple of years ago. It was confusing to me. But that said, what's the difference between a fund and a syndication?
So essentially, they're essentially very similar. There's different legal structures that you can call this a fund or not a fund. But essentially, anytime that you're bringing in a group of investors, a group of people, and any of those partners are limited, or there's larger than a handful of investors, essentially the Securities and Exchange Commission says you are now creating an investment and you're selling shares in an investment. And so whether you're selling debt shares or you're selling equity, you now have created a security. So in the sense that a syndication is investing in a security, it's like investing in a fund, because you have a legal entity that is basically essentially you're buying shares of that entity. Then there's kind of this different legal structure, a different type of syndication where people are creating funds to bring in a bunch of different investors by a bunch of different capital raisers. And that's a fund of funds model. So you've got this legal entity that owns your apartment building or your self-storage building or whatever it is you're investing in. You're selling shares of that entity. And then you've got funds that are created that go get their own investors to invest in their fund. And the fund becomes a limited partner of the main fund or syndication. So a fund of funds model is just another way to invest in a private placement security offering that we call a syndication.
It's all this complicated legal crap. So
can I try and cut through it a little bit?
Please.
Sure.
So here's the good thing to keep in mind. And we got a question in the Q&A also, like when can you do a syndication? When can you just use a note? So just to clarify something that might make this a little bit easier, typically speaking, we often talk about notes. And a note is basically you sign a contract, a piece of paper that says, let's say, Charles is lending me money. You sign a piece of paper that says, Charles lending me $100,000. I'm going to pay him back over a certain period of time and at a certain interest rate. And that's called a promissory note. And then maybe there's another document called a deed of trust or a mortgage where it says, if Charles doesn't pay me back, I get to take his property. So
no other way around, bro. I lent the money.
Exactly. I'm sorry. Charles Tarl can take the property back from me if I don't pay.
Right.
Of course he would pay. I'm the one that's likely not to pay. I don't pay my bills. No.
I don't want you to pay. I'll take your property.
Exactly. So that's what we call a note. And typically that's commonly used. Now, at some point, you can't use notes. You have to get the Securities and Exchange Commission. Everybody's heard the SEC involved. And you have to do this thing called registering your offering. And you have to do a whole bunch of paperwork and spend a whole lot of money. Generally speaking, if you are taking money from one person, and that person is a passive investor, you're good. You can use this note structure. You don't need to register anything with the SEC. You don't have to go through any special stuff. But if you want to take money from multiple people and what's called pooling that money, put that money together in a way that I can't separate Tarl's money from Ashley's money, from Anna's money. They all give me money and I put it together into a deal and it can't be separated out. If I'm going to do that, then I need to register my investment as what's called a security. We're pooling money. They're passive partners who aren't doing anything. They have no say in the deal. They're just putting money in. Then I have to register. So long story short, if you have one person that's putting money in and is going to be a passive partner, you don't need to go through any of this process. But if you want to pull money from multiple people and they're all going to be passive investors in the deal and you can't separate their money out, then you have to go through this process called registration with the SEC. And that involves getting attorneys involved and accountants involved and filing registrations and paying fees. And I will let Ashley and Anna talk more about the actual costs of that because they've done it a whole lot more than I have. But typically speaking, that's the rule. If I want to flip 100 houses and I want to get a separate investor for each house to lend me money, I can do that no problem. But as soon as I want to get more than one investor for one house, that's when I have to create a fund or a syndication, and I have to go through a whole bunch of headache.
And two quick things that Jay, you said that are really important. One is the number of investors on the deal, and two is their passivity or their active involvement in that deal. So I can put together, like if I want to do a deal and I want to buy an apartment building and I just want 2 or 3 other investors, as long as we're all active in some way in that deal, we don't have to go form a syndication. We just create a joint venture and we all invest in that together. So that's one way to raise money from a smaller group of people. But once somebody's passive and they have nothing to do with generating the return on that deal, that's when essentially the SEC says you're selling a security. Or if they're all passive and you're bringing in more than one person in that particular deal, then the Securities Exchange Commission wants you to create a registration statement and a syndication.
So Ashley, so I take private money all the time. Like I'm one of those guys. I don't pay for anything on my properties if I could avoid it because we do too many deals, and I use my capital for operations purposes to go get more deals, hire more people, all that great stuff. And also I'd like the whole spreading the love and helping other people make more money, and also spread the risk too. But that said, why would I ever want to syndicate a deal? Like if I could just go pay 8% to a private lender. Versus if I go syndicate deals, then I got to go give a whole bunch to all these limited partners and stuff. At what point is that a good idea? Because in my world, I'm like, I'll never do that. I pay 8%, 10%, whatever to all these other people. But why would I want to syndicate? Or at what point would I want to do that?
Syndication allows you to increase the magnitude of the deals that you're doing. So when you are going after properties like the property that we were talking about very early on, the property we just all acquired, we would not be able to go most likely after one single investor unless we went to maybe a family office or some sort of private company or organization that could lend to us in that manner. But the volume in which they're lending lends itself more to a syndication route in terms of the acquisition. So the idea here is that, multiple individual smaller investments at, let's say, $100K a pop can do massive action. You can tackle larger investments. So that's one way in which it's very advantageous to syndicate.
And also keep in mind, another thing is that syndication and versus going a note or something else is completely independent of whether you're offering 8% returns, or you're offering 70% of the equity, 70% of the deal. Those two are completely separate. I know somebody that has raised over $100 million, and it's all registered as a security, that he has a big fund and he pays investors 6, 7, 8%, nothing else. So same thing you're doing, but he's doing it in a syndication model. Like Ashley said, he can now do it at scale. He can bring in 1,000 or 10,000 investors as opposed to having one investor per project. So that's number one. But the second question is, why 8% versus giving away 70%? Well, the 8% is probably going to be a loan. You loan me money, or you come into a deal where it's a loan, I'm going to pay you back that 8%. It's not a high return, but if I lose all my money on that deal, if that deal goes south and I go bust on that deal, if it's a loan, I still have to pay you back. Legally, I'm still on the hook to pay you back. You're not sharing in the risk. So you're only paying 8%, but if you screw up and you lose a bunch of money on that deal, you're still on the hook to pay back that lender. When you give away equity in the deal, they become a partner. And so typically when you give away equity, it's going to cost you more money. Equity is typically more expensive than debt. So if we give away, let's say we do an apartment complex and we give away 70% of that equity to our investors, if we lose money on that deal, we're not on the hook to pay those investors back. They're sharing in the risk. They come in knowing that they have a risk of actually losing money as opposed to your 8% lender. Our investors have a risk of losing money. And for taking that risk, they get a much higher reward if we do well.
Love it. So what are the actual costs though? Like when it comes to raising a fund, syndicating, like, cause you just said 70%, you threw that out there. And Anna, do you want to take on like, what are some, why? Because there is a cost involved in creating this stuff, right? And actually going through it. And that's what also I mean by at what point is it okay to like pull that trigger, right? When it comes to it. But like, what are some of the costs involved of starting, if I'm going to go start a syndication or start a fund?
Sure. There are definitely costs involved. And that's one reason that oftentimes we're not really going after syndications. At least you don't see a lot of people doing syndications unless it's a big deal. You've got to have enough scale to pay for the legal costs, the SEC registrations, the filings that you have to have, essentially, or exemption filings for every state that any of your investors in. So you've got legal fees to create contracts and to create your offering. You've got the SEC filing fees. And typically, it's going to be at least $30,000 to $40,000, in legal fees and SEC fees to put together a syndication. So if I'm going to buy, a 70-unit apartment building and I need $2 or $3 million in equity, as the down payment and the operational reserves for that, and I can get loans for the rest, I'd rather go after one or two joint venture partners and take that down and not have to go through a security. But if I need to raise, $20 million, $5 million, $10 million, it's then because of the scale of the amount of money we're raising, that $30,000 or $40,000 legal fee and those SEC costs are really small as a percentage of the amount of money that we're making.
Yeah, in reality too, most syndications or funds then end up paying for those fees as well once they're internal, once you raise the capital.
Right. We build it into our cost. So essentially, as a part of every deal, the purchase price of the property is just one piece of that. So you've got your purchase price, you've got all of your settlement fees, you have your legal fees, your SEC fees, any other auditing fees. So once you create a syndication, you've got to have financial statements and audits. So you have a little bit higher accounting costs typically than you do otherwise. But you build all of that into your business planning, your model when you're creating your returns.
But can I just add one point? So what you're saying, Anna, is that ultimately the way in which an organization is structured and the way in which you build out however you're structuring the partnership and the ownership group, that cost and the cost of your capital could be the make or break of you being able to acquire a deal in the first place. So ultimately, it really comes back to how creative can you get with structuring your capital stack. If you can get really creative and get the cost of capital down, both on the debt and the equity, your purchasing power increases. If you have a high cost of capital, both on debt and equity, your purchasing power diminishes. And ultimately, it could take a long time for you to get your next deal. And investors want deals all the time. So to be able to provide deals continually, you have to get really creative on structuring the appropriate, infrastructure in which it doesn't have a high cost. To your point, Anna, about, the legal fees and whether you're structuring as a fund or a syndication, those get pushed through, but they can really be detrimental to your purchasing power.
So let's switch gears a little bit. Now, today is, the hell day is it? November 4th. Wednesday. It's always Wednesday. It's always Wednesday. So today's Wednesday. Now, I've raised capital over the years. You guys have all raised capitals over the years. I can't help but feel this year's been a little different. So what, as far as raising capital this year or now, or whatever, even if the last month or two, has anything really changed compared to your experience raising capital last year? Anna?
Sure. Yes, there has been changes, and part of that's because of the pandemic and because of the eviction moratorium. Because we're raising capital for apartment buildings, and people that aren't super sophisticated, already accredited investors who've invested in apartment deals, have been a little more hesitant to, before where it might be, hey, you can get me a 9% return or a IRR of 15%. I'm writing you a check. Now it's, I'm a little nervous because what if you can't collect rents and, this pandemic shutdown lasts longer. And so my investors who have a lower risk tolerance have definitely been a little more nervous until they saw what was going to happen with the pandemic and what was going to happen with the election. Because the thought is, if it goes to the Democrats, there's probably going to be more shutdowns, stronger eviction moratoriums. And so there's been a little bit of fear that made, I think, raising for certain deals a little more difficult. But at the same time, we have a lot of investors who are experienced and who really understand the power of multifamily as a strong hedge for preservation of capital. And so they understand that over the long term, yes, we might have a blip for a short term, but a lot of time institutions buy these big apartment buildings because they are a fleet to preservation and safety of capital, compared to kind of a stock market that's up and down. And so our investors that really care about preserving capital, and they're more patient for that growth, they're willing to sit in it a little longer and not as nervous about the cash flow, they're happy to invest right now. Those are a little more risk averse and really want the income and the cash on cash return. They're a little more averse to investing right now is what I found.
Perhaps it's also their confidence level of the operator and the GP to begin with as well. So, reputation matters, right? Ashley?
Yeah, I was going to also add on to what Anna was saying. So it looks, from my perspective, the individual investors were more risk adverse. But if you look at the PE, like the private equity groups, they didn't have as many investment opportunities as they did last year. So they were very hungry to place capital because their capital was sitting idle, and idle capital is actually, in essence, losing money. So you saw that on the equity side. On the debt side, the difference is when you look at Fannie and Freddie, they have quotas to meet every quarter on what they need to lend to, on how many properties they underwrite. And they didn't fulfill that quota for Q1 at the tail end of Q1, Q2, and Q3. So all of a sudden they had to catch up on all these loans that they needed to originate by, through the end of 2020. So in terms of the loosening up of their terms, their loan terms, there was a lot of speculation that it would look similarly to how it looked in 2008, with reserves held for a year, prepayments, all these different restrictions on how much equity you needed to have as a, underwriting and signing on the loan, net worth and liquidity requirements. But what they did is they actually loosened up on their terms as opposed to stricken or make their terms stricter. So you did see, in terms of having reserves, you saw that increased. But in terms of liquidity, that actually, net worth, you actually saw that loosen up, which was counterintuitive than what we saw during the last recession, and then also to what we saw last year.
Fair enough. Dig it. So let's get into that. So you said something earlier. You said something that kind of went by pretty quickly. Is the private equity firms that are out there? They're like, I got money to spend and I have no place to put it. And maybe the private investors are a little bit more nervous because it's their private capital. So let's go into that when it comes to the actual funds themselves, because there's sunset clauses. There's all these aspects of if you don't spend the money, it comes a liability. What are some of the pitfalls and negative things that when it comes to raising a fund, especially if you can't deploy the funds. And this is a fund versus a syndication as much, because typically a syndication, you're doing one deal and the deal is already there, right? But you can also fail at a syndication too. So let's go through those negative aspects. And let's start with one of the major negative aspects of raising an actual private fund, and that is not being able to deploy capital. So what happens if you can't spend the money you got? Anna?
Sure. So I think one depends on what is your business model. Are you raising money for your own deal that you're one of the sponsors of and that you're an operator on? Or are you a capital raiser that doesn't want to operate your own deals, and you're basically trying to partner with other people and other operators and bring your investors good investment opportunities that you can then go and invest in? And that's a very different business model. Also, whether you're an open fund or a closed fund. So in most syndications, what we see is people will create a fund of funds, and that fund is a closed fund. So people know exactly what they're investing in. They're investing in one deal, and they need to raise money for that one deal and come in as a block, as a fund, as opposed to investing in a larger fund by a capital raiser who basically doesn't operate any of their own deals, and they partner by going in and buying with another operator group, a bunch of apartment buildings or a bunch of self-storage buildings. And so there are funds that are created that are open-ended funds, or they're blind funds, where essentially they're raising money and then they're waiting to try to go find a deal and deploy. So the negative is if they raise this money and they can't find deals, they're paying interest or they're paying a return on a deal to those investors when they don't yet have a deal, or their investors get antsy. The other negative is if they're trying to raise enough money for a particular deal and it's a closed fund and they don't raise, they may not be able to have enough and a high enough investor threshold to go into that deal at the discounted NAVs and to get paid basically for bringing investors to that deal.
And so what happens then at that point if you have a closed-end fund or a syndication and you don't actually raise the money?
Your fund would be in jeopardy. Your investors might not be able to invest in the ultimate deal if you don't bring in enough, or the ultimate deal may not be able to close if all of the co-sponsors together can't raise the money for that deal.
But what kind of financial liability does that have on me if I'm the one trying to raise the money or set the syndication?
If you were trying to raise money for a fund that couldn't ultimately invest in the deal because you didn't raise enough, you'd probably want to return your investors' money because they wouldn't have a way to get into the deal. So you'd have to return the money and then essentially look at your legal and securities documents to see if you owe them interest during the time that you held the funds.
Yeah. And also you had to pay for the legal documents to begin with too.
Right.
So, yeah. So you're out of money, right? So there's some risk involved in that part.
For sure.
And we can go down, we'll allow an attorney one day explain, maybe we'll have Raul on here again, but where they can explain all the things they can do that it is, because you open yourself up to a lot of liability though, don't you, if you're running and managing a fund, and more liability so than possibly if you're just borrowing it as, a private note, because aren't you responsible for those people's funds as a fiduciary at that point?
Sure. And there's all kinds of different regulatory issues as to whether or not you need to register as an investment advisor once you're a fund manager, whether you're giving investment advice, whether they're open or closed-ended funds, how much money you're raising, how many deals you're doing, where your investors reside. So there's all kinds of new fiduciary responsibilities that you have where you may either have to register or register exemptions as an investment advisor or as a broker-dealer if you're raising capital for other people's deals. And it gets quite complicated, but it's a high dollar, higher risk game. And the more investors you're bringing in, the more responsibility you have, as well as risk that you have if you're not explaining to them very, very carefully exactly what they're investing in, making sure that they understand the investment and that you have the proper registrations. And that's, why there's different ways to do funds and do deals. There's different types of registrations you can do with the SEC, like a 506B or a 506C, that have a different level of qualifications and financial acumen of your investors that help you kind of reduce some of that risk if you're only, going after investors who are supposed to be sophisticated enough that they understand those investments.
Love it. I do. I mean, I would, for time's sake, I'd love to go into that in more detail, but I do want to switch again let's talk about, this is something that gets asked all the time, is that like, how do you actually find these people that want to give us money? And I know, Jay, you had said just talk to people, but like, are there some other elements to be able to, how do I find a private lender? How do I find a private investor that wants to give money into my fund? What are some common ways to do that? Or if I'm starting out not knowing anybody, how do I start to find people in this component, like in this realm, so that way maybe one day I can raise capital in some way? Is there anything I can do today?
Well, keep in mind that we talked a little bit about raising money isn't always about just getting somebody to hand you money and walk away.
Yes.
There are other ways to do it. So I mentioned seller financing. So seller financing is a way of getting somebody to give you money where they're not actually handing you cash. So that's the situation where you buy a property and the seller of the property is willing to take less than the full purchase price now. So they're basically giving you the money by paying themselves. And then at some point in the future, you pay them off, maybe when you sell the property or when you refinance the property. Another great way to raise capital is to bring in a partner. So we often think about a lender, somebody giving us the money and being a passive investor. Maybe bring in an active partner. So maybe I'm getting ready to do my first deal and I call you, Taro, and I say, hey, I found this great deal. I don't have the money. I don't have a lot of experience, but we can make $50,000 on this deal. If you bring the money and you kind of help me through it, I'll give you 60% of the $50,000 profit. And you might be thinking, well, hard to find deals these days. I've got lots of cash. I don't mind helping this guy, Jay. He seems like a nice guy. You come in, you bring the money, we partner, and you get $30,000. You didn't have to find the deal.
But how do we find me? Like, and how do you find that potential partner? How do you find that potential lender? Like,
Absolutely.
what do you?
Good. Yeah. Well, there are plenty of meetup groups, real estate investor associations.
Only in Florida right now.
Nope, everywhere. A lot of them are doing it online. You can still meet people online. There's bigger pockets. Let me tell you something. If I could 7 or 8 figures, the amount of dollars I've borrowed and partnered with on people from bigger pockets. I've built those relationships over the years. So go start now. Go into local Facebook groups and start networking with people there. Basically, when you're looking for partners, I mentioned when you're looking for lenders, private money, it's everybody you meet every day. If you're looking for partners, it's probably going to be people that are in the real estate space, and you're going to meet them where people in the real estate space hang out. And that's real estate meetings and meetups and REI groups and bigger pockets and things like that.
I agree 100% with that. And that's where, bigger pockets is a huge component of that when I was starting out. Like something that I did, like it's different now, we videotape everything. But what I did early on is I would do case studies of a house I flipped and I would put it on Bigger Pockets. And that actually is what made me popular on Bigger Pockets, was I was doing these case studies of a breakdown showing before, after, the issues, the things I learned about the project, everything on there. And it made me very local. And I would use key terms for Seattle and like all this kind of stuff in Tacoma. And it made me very popular locally because I was the only one locally in my area that was doing those case studies in my market, right? And that led to me meeting more people, right? And it gave me like a credibility source to show like, oh, look, I've done case studies on Bigger Pockets, and it actually got me to where I could be a blog writer with them and all this other stuff later. But it all started with that, just being able to show and tell what I was doing. Now you got social media and this like, Instagram thingy and TikTok thingy or whatever that crap is. And you can show and tell, right? And you almost are building your portfolio at that point to be able to show other people what you're doing as you're doing it. So all good ways to find money, right? And asking. I know, for one last quick thought on my part, where my business changed is when I was introduced to a private lender through an attorney. And he was just an older dude who sold his company years ago. And he wanted to lend out money to single family investors. And my attorney said, "You want to meet him?" I'm like, "Yeah." And so when I met him, I was able to show him what I did already. It was a 30-minute coffee appointment, right? We're great friends now. We've been doing business for years together. But after that 30-minute appointment, like literally within 60 days, I owed the guy almost $4.2 million just from private lending, right? But it was because I was able to show him what I did. And it just comes to talking and asking people. So. But
Carl, I think something really important that you just said, and Jay alluded to as well, is, we used to think, how do you raise private money? And if you read books 10 years ago, it's like, how many people do you know? You got to go to a zillion meetups and you got to, have an elevator speech everywhere you go. And while you want to do that, now marketing is more about who knows you than how many people you know. So your net worth really does grow with your network. And it can be that you know the attorney, but now word of mouth has gotten out about you because of their confidence in your competence and your integrity. So, word travels fast, and real estate is a small community, brought together through our network. And so the better you are at reaching out, making sure people know who you are by doing those kind of videos, engaging with other people, whether it be your attorney or Bigger Pockets, the more people get to know that that's what you do, the more people are going to start asking you, how can you make me money with what you do, and bringing you money instead of you having to ask.
Keep in mind, I work and do deals with all three of you, and we haven't known each other since we were born. We all met, and we've met in different places. Charles, you and I met at a conference.
We've spiritually known each other since we were born.
Maybe.
So.
We're
kindred spirits.
Ashley, you and I met at a different conference. And Anna, you and I met through mutual friends. And so it's really all about getting out there and networking and meeting people and talking, having discussions. I mean, Taro and I met because we sat down in a mastermind together, and we just started talking. And we realized we had things in common.
I was like, do you like beer? And you're like, yeah, I like beer. I'm like, oh, me too. We should be best friends. Let's go get beer. And then we did. And so that's how that all worked out. But
yeah. And so literally everybody I've done deals with, I've met somewhere because we started talking, and then we ended up doing deals. And let me tell you something, 10 years ago, it's not like people knew who I was 10 years ago. Most people still don't know who I am. But I have conversations with people, and they hear what I do, and they want to work with me, and I want to work with them. And there you go. It's just, it happens, and it takes time. I'm not, again, it's simple. It's not easy. It takes time. It takes work. It takes patience. It takes guts. I'm tremendously introverted, so it's hard for me to network with people, but I force myself to do it. Yeah. The reason Taro and I are friends is because I latched onto him at a conference because I'm so introverted. I didn't want to meet people. And he was the first person to talk to me. So I'm just like, can I follow you around all weekend? He's like, sure.
Yep. And it was fun.
People think I'm kidding when that's almost exactly how it happened.
He was like a little puppy. It was great. So anyway, but yeah, and then we had lots of beer and we met lots of people. So, but yeah, I love that. It's also consistency. What you're saying too is like you all three of you, consistently put yourself out there, consistently show what you're doing, consistently talk to people, and you just build that up over time. And it's not the fastest game in the world. Sometimes you get lucky and you find somebody that can change your business overnight. But sometimes it takes years. So, and you just got to consistently do it. So let's get to the questions that are out there. I was about to do that, Jay. You didn't need to text me. So just put you on blast. All right. Now, let's see. What's a good one? I like this one. This is more of a passive investing question. If I invest in a syndication, which means I'm a limited partner and I'm going to put money into it, would I get cost segregation deduction on my tax return? The income I receive from a syndication will be taxed as ordinary income?
Tax matters can get complicated. When we do a multifamily syndication right now, based on the current tax code, we can do a cost segregation and accelerate our depreciation in year one through something called bonus depreciation. So that depreciation would pass through to both our general and our limited partners. There's some legalese that has to be in your PPM that shows that that's what happened. But whether or not you're able to use that is very, very highly individualized based on your own income, your own situation. Like for me, for example, I'm a full-time real estate professional. So because I'm a full-time real estate professional from the IRS's standpoint, I can take unlimited losses. So if I have $1 million, bonus depreciation for multiple properties in a year, I won't have to pay taxes for a long time. But other people, they might be limited to only be able to take like $25,000 a year of those losses because they're passive and not active. So it's very complicated. It's very individualized. You can't really make a blanket statement. But in general, if you're able to use depreciation, you can take that depreciation from the syndication and give it to your accountant to see how much he can wipe out of your taxes based upon that depreciation.
Two other points to add there to what Anna just said. First is that they have to be like-kind investments. So if you are getting bonus depreciation off of a passive investment through apartment syndication and you want to write off your gains off of a flip, you cannot do that. That's not a like-kind investment. So that's the first point. And then the second point is that while it may not be able to be deducted in year one, it carries forward. So it's not a use it or lose it type of depreciation. But to Anna's point, I'm not a CPA. I know Anna's not a CPA. So ultimately, what we always say is that anyone who's investing in real estate as a passive investor should always seek the advice of a CPA, especially someone who is specialized in real estate. A lot of investors will seek advice from a financial advisor. A lot of financial advisors are paid off of the investments in which you invest, and real estate doesn't typically fall as an investment that they get a commission off of. So therefore, their advice is biased. Seeking advice from a real estate qualified CPA, someone who works intimately with your financial situation, will give you the best advice for you so you can leverage all of these tax advantages that a financial advisor probably wouldn't be privy or knowledgeable on because they're just not trained in it.
Thank you very much. All right. This is all smart talk. Right. All right. Kenny is asking, Ashley, you take this one because you brought this up yesterday, Ashley, that had to do with this B and C thing. I don't really understand it. Kenny is asking, do you have to be an accredited investor for a syndication?
No, you do not. So the two most common syndications, it's not the only way in which a syndication can happen, but is under what is SEC Reg D 506B or 506C. So 506B syndication offering is one in which you do not need to be an accredited investor, but you need to have a pre-existing relationship with someone on the general partnership team. Unfortunately, the SEC doesn't clearly define what a pre-established relationship is. It doesn't set a time limit or, the length of conversation or how you were introduced. A 506C offering is one in which you can have accredited investors and advertise, but you can't have non-accredited investors. To qualify as an accredited investor, you can always ask Dr. Google, but there's actually a very lengthy explanation as how you qualify because you can qualify as an entity or an individual. Most people refer to the qualifications of an individual qualifying, in which case you would qualify under a net worth of $1 million or more, not including your primary residence, or making $200,000 or more as an individual on your past 2 years on your tax return and for the foreseeable future, making that much income or more, or as a couple making $300,000, and the same qualifications would apply. Like I mentioned, there are other ways in which you can qualify entity-wise. So just seek, Dr. Google for that because it links directly to the SEC website.
The Google cave. All right, so let's go to the next one. Mike is asking you, Jay, and he spelled out Jay, by the way, so maybe I shouldn't even ask this question. But Jay, when you are talking about debt or a note that would still be owed in the event of default, are you talking about an unsecured note?
Okay. So typically, if I'm going to get work with a private lender on, let's say, a single family house, I'm going to work with one lender. I'm not going to work with a bank and a lender. I'm going to work with the lender as opposed to the bank. So there's only one person giving me money on a deal. When there's one person giving me money on a deal, and it's like a single family house, they are going to get a note and a deed of trust or a mortgage. So basically they're going to get a promise that I'm going to repay. That's the promissory note. And then they're going to get a mortgage or a deed of trust against that house. That's the collateral piece of paper that says, if I don't pay, you get to take this back. And so because I only have one of those on a deal that I do, only one of those people, they get what's called first lien position, which means if I don't pay, they get to take it back. If I wanted to get a second lender, if I want to get somebody else to give me even more money on top of that first person's money, well, then you get into junior lien positions and somebody taking more risk, because if I don't pay, then two people try and have to come after me for money, and one is in gets first dibs at coming after me. The other one has to wait. But generally speaking, to make it simple, if I'm going to do a deal and I'm going to have a lender, it's only going to be one lender, whether that's a private lender or a bank or a hard money lender or a small bank or whatever it is. It's going to be one person, and they're going to have the property as collateral.
Excellent.
Hopefully that answered the question.
Yes. First mortgage, second mortgage, debt, take my property. Allison is asking if you create a fund? If you create a fund, can you keep reusing the raised capital on multiple properties over years? Kind of a big question. What that actually means. Anna?
I don't have a lot of experience with this, but I do know the rules from a broker-dealer standpoint. So essentially you can do it, but you're basically moving into the realm of, rather than necessarily being an operator, you're moving into the realm of becoming an investment advisor. So you have an open-ended fund, and you're taking the role now of taking investments and finding all kinds of different investments to make your investors a return, putting that money back in once you sell it, and then reallocating it into something else. So that's called an open-ended fund. And typically you have to at some point become an investment advisor, because now you're giving investment advice rather than providing a single vehicle, which is real estate, that investors are coming to invest in that single deal that they know, there's a start, there's an end, and there's a pretty predictable return there.
Yeah, at the end of the day, when you talk to there's many different fund attorneys out there that know how to structure these things. And there's ways, as long as your paperwork's in alignment, it's just a different thing. You got to know what it is. And when you're doing that. So here's a question. I like this question because this is what actually stopped me from a long time of even looking at this. Kenny's asking, how do you determine how much of a percentage that you can give the investors versus how much the general partners get to keep? What percentage makes it worth it?
So the answer is it's a negotiation. It's just like anything else. And you need to do something that makes it worth your while as the operator. You're spending a lot of time, so you're risking time for the most part. So it has to be worth the investment of time that you make, and it has to be worth it for the investors. They need to be getting a return that's commensurate with the risk that they're taking. So these days, and every fund's going to be different. I mean, you can find, I know somebody that's paying 8% flat to his investors in his fund. Typical multifamily real estate fund these days is paying 14, 15, 16, 17% compounded returns over 3, 4, 5, 6 years, somewhere in that. So that's what's typically being paid. But you can pay whatever. If you're doing a really low risk deal, you might pay less. If you're going to do a really high, let's say you're doing an oil and gas investment, and I know nothing about them, so I'm assuming that's higher risk, you may have to pay much higher returns. So it's really whatever works between you and your investor. In terms of how you determine whether you're giving up 50% or 60% or 70 or 80%, well, you have to sit down with a spreadsheet and you have to actually model out the deal. And you have to say, if I give them 60%, is that going to make me enough money that it's worth it for me and them enough money that's worth it for them? No. Well, how about 65%? How about 70? How about 75%? And you just have to model it out. That said, there are some standards, at least in the multifamily space. In the multifamily space, it's typically somewhere in the 60 to 80% goes to the investors, and 20 to 40% goes to the operators, the people that are bringing and operating the deal. 70% is kind of the rule of thumb, but it can be a little bit more, a little bit less. And again, if you're bringing a much higher risk deal or a much lower risk deal, you can play with the numbers any way you want so that both sides agree.
All right.
And Ashley and Anna, if I got that wrong, you've been doing this a lot longer than I have. Please correct me.
No, I was just going to actually add on to one thing that Jay was saying. Ultimately, it comes down to your investor database, right? So if your investor database is full of savvy real estate investors and you have built that investor database by educating them on real estate, they're going to have higher expectations, and they're going to have set metrics that are probably consistent with industry standards across multifamily, mobile home park, depending on the asset class in which you're investing and the risk associated with it. Whereas if you're going after investors that maybe are either A, not knowledgeable about real estate, or B, don't give a shit about it, and they just care about placing capital, they're going to have different expectations because their expectations are probably governed by the stock market. They're governed by something they know. So ultimately, you have a little bit of flexibility based off of the database in which you want to target.
Absolutely. So now let's wrap up, guys. We've been going for a little while here. And I want to end on going to each of you guys to kind of give one last piece of information that you want to share, plus also end on how can they get a hold of you in the future as well. So let us start with you, Anna. Last piece of information to share, and how can people get in touch?
Right. I think just, always be looking at deals and get creative. Your success really comes down to how can you marry opportunities creatively with other people in your network and create them a return and create you a return. And every market gives you different kind of opportunities and different returns that you can give to your investors or create for yourself, but you really can't do it and grow successfully long-term without getting creative and finding ways to get capital, whether that's through private lenders, private equity partners, syndications, et cetera. Just start looking for other people and utilizing other people's money in what you're doing. And then to get a hold of me, you can find me on Facebook at Anna REI Mom Kelley, or you can email me at info@reimom.com. Website's www.reimom.com.
All right. And I just realized that I'm an asshole for calling you Anna this whole time. Jay, you're next.
Okay. So what's my final tip? Just make it a win-win. Anytime you're working with somebody, give a little bit more than you might want to give or need to give. Make it worthwhile for the other person, because a good private lender or a good investor, somebody that invests with you or beside you, is not somebody that you're going to hopefully work with once or twice. A lot of the lenders that I've been working with literally for 6, 7, 8, 9, 10 years. And the reason that we've been working together so long is because I know that they're always going to be there if I need something, and they can give a little more. They know that I'm always going to work hard to give them a little bit more. And we care about helping each other. It's not just a financial relationship. It's a long-term financial relationship where we both have each other's interests. So always be willing to give and make it worth the other person's while.
And how do they get a hold of you, Jay?
And if you want to get a hold of me, well, if you want to,
which he is an influencer on Instagram now. I just want that to be a big deal.
I have hit 10,000 on Instagram.
Yeah.
If you want to get a hold of me, well, let's say if you want to invest with me, and look, here's a tip right here. Always have a way for people to invest with you. If you want to invest with me, you can go to investwithj.com, investwithj.com.
Look at you. You started the whole URL.
Yeah, look at that. And you can fill out the little form right there. And if you want to reach me by email, which that form will go to my email anyway, but if you just want to hit me directly on email, j@jscott.com.
And last but not least, Mrs. Ashley Wilson.
My last little tidbit for everyone is a little over 2 years ago, I was part of a general partnership in which we had to raise $2.3 million. And we had almost 3 months to do it in. And we showed up at the closing table $250,000 shy of being able to close. And we had to borrow it from someone to get to closing. And then we raised after the deal closed to replace that capital that we had borrowed. Fast forward 2 years, we just over-raised almost $11 million in less than 4 weeks. And to think that you could do something like that in just 2 years' time, if someone had said that to me, I would have thought that they were out of their minds. But ultimately, that came down to the network that I had built out by putting myself out there, always being transparent, always being approachable, honest, and always trying to help other people. And it's because of that, it's the reason I have met, you, Tarl, Anna, and Jay. And now, Jay and Anna are partners of mine on this deal that we just acquired and we over-raised on. So don't be overwhelmed by listening to stories like us where we're talking about $20 million deals. We all started with our first deal. It's steps, incremental steps each time. And it's amazing how quickly you can get, build traction. And you can reach me at badashinvestor.com or on Instagram at badashinvestor.
At Ash.
Bad Ash.
And I forgot about myself. All right. Let's talk about me for a second. So my last piece of advice for everybody when it comes to this is the ease of money versus the cost of money is a big deal, in my opinion, depending on your business model with what you do. I think that, in my business, I'd rather pay a little bit higher interest rate and a little bit higher fees, potentially even just for the simplicity and ease of the money that I'm using. And also when it comes to the speed of it as well. So like, for instance, maybe you have somebody that's in a friendship or relationship with you that wants to give you a private note at 6%. But they're going to come to the house every single day and they're going to bug you and they're going to be stressing the hell out of it all the time because it's all the money they got. I don't want anything to do with helping that person with investing their money, right? So I'd rather pay somebody 10% or something like that. That is a seasoned professional in what they do and they let me do what I do. And the money is easier to actually use, even though it costs a little bit more, if that makes sense. So ease of money versus cost of money is important to me. Just something to think about. That said, you can also get a hold of me at Tarl Yarber on Instagram. I am not as popular as Jay Scott because I do not sell myself out as much as no, I'm joking. But for that,
and remember, and also if you want to invest with Tarl, you can go to his website investwithj.com.
That's right. That's true. You can totally do it. I'm sure it'll circle back to me somehow. And I'm certain of it. Almost. I think. I don't know. That said, now I also want to end on this, guys. We do this every single Wednesday. So come join the show every Wednesday, Fixated on Real Estate Experts Live. It's 12 p.m. Pacific Standard Time. If you want to watch it live, you can also watch the recordings later. And you can join us live on the webinar version of it. So we can ask your questions directly on the Q&A every single week too. And last but not least, I want to thank my friend Caitlin, who made the Bigger Pockets thread with 80 comments or whatever. And that is now forever live on the Bigger Pockets page. So thank you, Caitlin. That's it. Thanks, guys. Thank you, Anna. Thank you, Ashley. And thank you, Jay. And we'll see you guys next week.
Thanks, everybody.
Thank you.
Thank you.